Good afternoon, everyone. My name is Becky Reckers. I am the Director of Retirement Plan Services here at Capital Wealth Management. I'm joined today with Will Tuttle, who is our Chief Investment Officer. Capital Wealth Management is your advisor on the 401k plan. And today we want to focus on what's been going on in the market this past 2 quarters. We think it's important to have an understanding. I know there's been some key events that you've seen on the news, so we're going to focus on those, particularly in the UK voting to exit the European Union. And then we'll talk a little bit about your overall investment strategy for retirement. And with that, I'm going to hand it over to Will Tuttle, who will talk about the market.
Thank you, Becky. My name is Will Tuttle. I'm the Chief Investment Officer for Capital Wealth Management, and thank you for joining us. So far this year, we've seen some significant volatility, both in the first quarter and most recently at the end of the second quarter. The first quarter's volatility was driven mostly by what is turning into a slowdown in the Chinese economy. The Chinese economy has been a driver of global economic growth for many years now. But as their economy is maturing, their growth rate is starting to slow. That means they are importing fewer raw materials from abroad, and they're also exporting less finished goods as their middle class has grown to consume more of that. And that slowdown of global trade that is resulting from a sort of slowdown in the Chinese economy really drove the downside volatility in late January and early February of this year. The markets recovered from that as this slowdown in the Chinese economy was kind of overblown, in my opinion. The actual economic impact globally is not going to be as big as was first feared. The Chinese government and their central bank is going to make sure, because it's so centralized as a still sort of communist economy, that things go okay one way or the other. Once the government stepped in to make sure that Chinese stock markets did not collapse, then it became more or less clear that the rest of the world was going to be okay also. The most recent spate of volatility came from the vote on June 23rd for the UK to leave the European Union. Up until a couple of days before that vote, it actually appeared that the referendum would vote to stay. The result of the referendum would be to stay in the EU. So the outcome was a bit of a surprise to everybody, and that drove stock markets around the world down quite a bit. I think it was about 8% in the US over the next 3 days after the vote on the 23rd. Since then, stocks in the US have recovered and actually have made new highs since that time. And international stocks have pretty much mostly recovered from that period too. This is because it's going to take a long time for the UK to actually leave. The official start of the process is after basically a letter of intent is sent to the European Union. That has not happened yet. It will probably take a couple of months for that to happen. And once that starts, there's a 2-year period of renegotiating treaties and contracts in order to allow a country to leave. The uncertainty comes from this has never happened before. A country has never left the EU. And we'll talk more about that in a few minutes, about the history of the EU and what is actually going to happen. Taking a look at some of the return numbers for the past few quarters, these indices are the benchmarks that we take a look at to see how world stock markets are doing. The S&P 500 is the largest 500 companies on the U.S. stock exchanges. The Russell 2000 is an index of smaller companies that are publicly traded. The MSCI EFA index is an index of large companies in Europe, Africa, and the Far East. The MSCI EM index is an index of emerging market countries such as China, India, Brazil, and others. So as you can see, there's been quite a bit of volatility over the past few quarters, a lot of pluses and a lot of minuses. So if you take a look at that for a moment. This slide is a look at U.S. Treasury yields. Treasury bonds in the United States typically set off or are a benchmark for other interest rates around the world. The 10-year bond is a measure of economic expectations for the next few years. These interest rates currently are at historic lows, and they have been for some time. This is an indication that the market is not expecting a lot of growth in the U.S. over the next few years, and certainly not a lot of inflation. This is being highlighted also by low interest rates on mortgages, lower interest rates on some consumer debt like credit cards and auto loans. So going back to the European Union and what it all means, after World War II ended in 1945, Europe was almost completely devastated and broke. For the past few centuries, every generation or so has seen a major war in Europe. As the Industrial Revolution took hold, these wars became more destructive and more expensive, and World War II was the culmination of all of that, with almost total destruction of France, Germany, and the UK, and large portions of Russia. The European Union was designed to prevent that from happening again by bringing the economies of the various countries in Europe so closely together that they had no choice but to get along. By forcing countries such as France, Germany, Spain, Italy, and the UK to work together, the feeling was that, much like the United States, all the various nations would have to work together. It would be very difficult to split apart, and it would be a united Europe rather than a collection of smaller countries that were constantly squabbling amongst each other. Some numbers on the European Union. The 28 member states, which currently includes the UK, again, they're not going to be actually leaving for a couple of years anyway, so all these numbers still include the United Kingdom. Population of the EU is approximately 508 million people. For comparison, the population of the United States is about 310 million. The GDP, which is a measure of the economic output of a region or a country, the GDP of the EU is around 19 trillion. For comparison, the United States is around 17 trillion. And a single currency, the euro, is used across 19 members of the EU. Notably, the United Kingdom does not use the EU. They are still on the pound. That was an exemption that they earned as a stipulation for joining the EU back in 1999. So actually, the EU is the largest economy in the world at the moment. And as a result, anything that impacts the EU, such as a country wanting to leave or parts of the EU like Greece and Italy not able to pay some of their debts, really has a large impact on how the rest of the world feels, given that it's the largest economy. When you break it, however, into smaller pieces, that impact is not so great, and I think that a lot of the volatility came about as a result of the UK, which is one of the bigger members of the EU, but not the biggest. You know, that country leaving the EU is going to make it smaller, but not significantly smaller. The desire of the EU was to sort of emulate the United States in that people could move freely from Spain to Germany or from Hungary to Italy, much like you can go from Massachusetts to California or Texas to Iowa without, you know, having to show your passport or change currencies or anything like that. It was to seamlessly bring all these countries together in a confederation, much like the United States. And for a large part of the past 19 years, it has worked pretty well. However, it has some problems. The differences between various regions of the EU are rather marked. Northern Europe is very productive. There's a large amount of natural resources and a lot of capital and very productive labor. Other regions, such as Italy and Greece, are more reliant on tourism because they don't have the natural resource base that other nations do. So they're not able to generate as strong an economy and the economic growth that other regions through Europe have been able to do. As a result, the past few years especially, Germany and France and the UK have ended up supporting some of the weaker nations in the EU, such as Italy and Greece. And that is starting to make people mad on both sides. It is making Germans mad that they're working to support what they consider our, you know, lazier cousins in the South. And Italians and Greeks are upset that this central government in Brussels, which is the capital of the EU, is telling them what to do to solve their problems. And that is causing all nations to have a certain degree of Euroscepticism, as they call it, a certain degree of they don't want to be part of the EU for any number of reasons. This experiment of the EU is going to have to end at some point, in my opinion. During the good times when everybody benefits, this confederation has worked really well. But as we've seen since the last recession and the more recent debt crises in Italy and Greece, it's very difficult for everybody to work together when times are not so good, and the pain has to be spread amongst everybody. And that pain is felt to be unfair by some peoples and less than fair to others. So not everyone is happy to be in the EU, whether your economy is doing well, such as Germany's, or your economy is not doing so well, such as Spain and Italy and Greece. But nobody's left, and that was a real reason for a lot of the volatility recently surrounding the Brexit vote and the referendum results. No, this hasn't happened before. How does this happen? There are rules written in the EU treaties, but since nobody's ever been there, there's no real precedent for how it's all supposed to work. The vote to leave the EU in the UK was very close, and as a result, it shocked a lot of people that voted on both sides. Both sides were sort of surprised that in the outcome. And currencies and stock markets reacted pretty violently. Stock markets around the world dropped pretty quickly for a couple of days. In the currency markets, the British pound dropped significantly. It has since stabilized, and as I mentioned before, U.S. stock markets have recovered completely, and in fact gone beyond those June 23rd, pre-June 23rd highs, I should say. And international stocks, for the most part, have recovered. Not completely, but they certainly are a lot higher than they were in the aftermath of the vote. So what happens now? The actual process for leaving the EU does not start until the British government sends a letter of intent to the central government in Brussels to actually leave. That starts a 2-year negotiation period where all of the contracts and treaties that have been signed over the years by all British companies actually have to be renegotiated. So every contract that a manufacturer in Manchester has with, you know, an exporter in the United States or an importer in the United States has to be redone. Every contract that a farm in France has to sell milk in the UK, that has to be redone. That's going to take some time. That's going to create some uncertainty and thus some volatility. But I think, in my opinion, I think it's going to be a good thing longer term for the UK. Is going to unshackle their economy and undo a lot of legislation that was imposed on them, and a freer economy is generally a stronger economy. And so I think longer term it's going to be good for the UK. At the time that we wrote this slide, Prime Minister Cameron had agreed to resign. He was going to do that in October. However, the next slate of candidates for that job came down to one, Theresa May. So yesterday, actually, she took over as Prime Minister well ahead of the scheduled October vote in Parliament to elect a new Prime Minister. Since she was going to be the only candidate, they decided to do it now. That removes a lot of uncertainty because now there's someone at the head of the UK government that is going to be in charge of things going forward in terms of the negotiations and the process of leaving. Leaving that job open for another 3 months was making a lot of people nervous, but now that there's a new Prime Minister, Theresa May, the feeling is that at least there's somebody in charge, and that's a good thing as far as the markets are concerned. And moving on to the implications. The general consensus is that leaving the EU is going to be a net negative to both the UK and the European Union. My opinion is a little bit contrary to that. I think eventually it will be good for both the EU and the UK to have this split. I don't think that the EU can survive the way it is currently. So forcing some reforms, forcing some changes that are much needed in the EU is going to help it survive. It has a lot of issues that it needs to deal with. This may force this to come to a head. And for the UK, as I mentioned, sort of disentangling themselves from a central government that was not always acting in the UK's best interest is ultimately going to be a good thing for them. They are now better able to determine their own course and to develop their own economy and rules, as opposed to having to work together with other countries that had different goals. Takeaways from this situation that we're seeing in Europe: a lot of peoples around the world, a lot of countries, a lot of governments are becoming more disillusioned with globalization. Globalization being freeing the trade between nations. Over the past couple of decades, we've seen free trade agreements between the US and Canada and Mexico, more recently with the Pacific Partnership. And while that has been a very good thing for the world economy, it's also forced nations to ignore some of what they need to do in order to grow themselves. And we're starting to see that sort of rise of nationalist feeling in Europe and in parts of Asia, where it's not always beneficial for globalization and free trade. It's not always beneficial to an economy to have that. So, the feeling is that we've got to start taking care of our own business and not be so willing to help others. Some of that will be good, some of that will be bad, but the bottom line is it's going to create some uncertainty as the global economy is going to have to change as a result. In conclusion, these are some of the points about coming change in the global economy. Some countries that had been historically low-wage exporters of goods, such as Mexico and China, are not going to be that anymore as their economies are growing and advancing and the standard of living is growing there. That's going to force them to not be the cheapest manufacturer of some stuff, and that role is going to go to other places. This is going to cause upheaval in some economies as those adjustments are made, and upheaval always brings volatility. So I think that some of the volatility we've seen in the past few months is going to be with us for a while. And going on to look at some of the numbers and how volatility is defined. Over the past, since the last recession, 2007, 2008, we've been in a period of historically lower volatility than usual. It certainly hasn't seemed like that at some times, but if you look at a graph of the S&P 500, for instance, it's been pretty stable going up since the last recession. But historically, you can see that we've had a decline in the stock markets of about 5%, about 3 times a year, a decline of 10% almost annually, and a decline of 20% or more once every 3.5 years. That we haven't really had that kind of volatility for a few years, I think a lot of investors and retirement plan participants have forgotten that volatility is a rule in the markets, and that some of these swings the past few months have reminded us that there is risk and there is volatility in the markets. Usually a decline of 20% or more follows a recession. We haven't had one of those since 2007. Some think that we're due for a recession in the next year or two. Some data supports that, but other data like the unemployment rate and wage growth doesn't support that. So it's hard to tell whether we may experience a recession and thus a large decline in stock markets in the next few years. But it's always good to be prepared for that. And being prepared for that means keeping things in perspective and monitoring your allocation between stocks and bonds. Stocks have historically returned more than bonds, but they've also been a lot more volatile than bonds. A younger participant, a younger investor, may be more able to withstand some of the volatility in the stock market, whereas a participant that's closer to retirement may not be able to withstand that volatility and be able to handle or stand a large decline in the stock market, and as a result should be more conservative in their allocation and include some more bonds in that allocation. The proper asset allocation, in our opinion, depends on a number of factors, including participants' time horizon, how long they have until they plan to retire, what their risk tolerance is, and their financial situation and goals. those put together into an investor profile helps us determine what we feel a proper asset allocation recommendation would be for participants.
So we think it's a good time with everything that has been going on in the markets to really just hit the refresh button and take a look at your allocation, make sure it is appropriate, as Will mentioned, based on your age, your time horizon, your comfort level in investing in the market. And if that's something that you would like help on or guidance on, Capital Wealth is here to help you, with your recommended allocation, with your retirement goals. So please feel free to reach out to us. You'll see our number on the screen, and we're here to help you with your retirement goals. That concludes the presentation. Thank you very much for your time. Will, thank you for your input on the market.
My pleasure. If you have any questions, please feel free to contact us, and have a great day. Thank you.